when it comes to consumers, what that's going to mean for overall economic activity, what it means for earnings. We mentioned already today that U.S. futures were pointing to a lower open. You've also got these tensions between the U.S. and China, joining a list of investor concerns that are headlined by this fear of a global economic slowdown. All of that said, though, we are coming off a big monthly bounce for stocks in July. And our next guest is watching for signs of a possible bottom. Alan Nuckman is Chief Market Strategist at Bullseye Option. Alan, good morning to you. Thanks as always.
Good morning, John. As far as the bottom goes, we've got a great bottom base in place, and the confirmation would be if we get above those June highs in the S&P, the 4,200 level. That's already happened in the NASDAQ. The NASDAQ's leading the way. But if you could just look at the charts, which I do, just look at price action, it's very positive the way we made this bottom base and this breakout to the upside.
You know, it's interesting. I'm looking at what a lot of the strategists are talking about right now. And yes, and we just talked about an earnings story. If earnings deteriorate, maybe that's a concern on the valuation front. If the economic uncertainty lingers, you've got that too. One relatively bullish Wall Street firm, Fundstrat, is making the argument that the S&P 500, as you move through the rest of the year, could easily get back to all-time highs if you see signs of inflation continuing to cool. I don't think we've seen a huge number of signs yet, but he was pointing to 1982, where a period of a 3-year bear market was then met by signs of disinflation, and over the period of about, I think, 4 months, you saw the market make up its losses like 27%. And as you know from reading the charts, the S&P would not have to climb that much to get back to its all-time highs.
Right, and I don't think this is any different than what we've seen in the past years, not even go back to 1982. If we see what happened with COVID, we see what happened with all the other crises that we've seen over the last decade, the fundamentals remain extremely, extremely strong for corporate America. We had earnings growth this quarter, earnings growth, where we were expecting earnings growth about 4%. It's coming in hotter than that at 6%. Corporations are making billions and billions and billions of net profit. So nobody's losing money. They're making a ton of money. They've been able to have pricing power. They've been able to increase their margins. And if you look at the function of the price compared to earnings, the PE ratio was down at 15 for a bit before this bounce. We're at 17. So we're still about 20% off the January level. So there's a lot of upside in stocks. If you look at it technically, we've gone from 3,600 to 4,200 or so, very close. If we can break out of that level in the S&P, that 600-point range on top of that 4,200 sends us right back to the highs. So to say that couldn't happen is not something I'm going to stick my neck out. I'm very optimistic. I think the psychology has to shift, and that's what I talked to you about. We've had more of an issue of psychology and negativity than fundamentals hurting the markets.
So I just want to think about the factors that will determine that, because you're also going to get a chorus of people that will keep sort of looking at this as a potential bear market rally. We just had that key decision on interest rates by the U.S. Federal Reserve. Jay Powell, the head of the Fed, kind of outlining that over the next couple of months, as we wait for the next decision in September, there will be all sorts of data points that will inform central banks on how quickly the economy is showing signs of cooling, and also whether or not inflation is coming off its peak. Are those the key determinants, do you think, of the recipe of whether or not investors have decided the worst is over for the sell-off?
Well, I think the Fed has played this perfectly. And you've gotten, it's not just my opinion, it's the market reaction. The market has reacted positively. We've had crude oil drop 20%. Crude oils are now trading between 90 and 100. You've seen interest rates stabilize, and that's the big conversation we've had for the last years and years, is how the markets were going to react when rates moved up, which we knew were inevitable. But if you can see it, the 10-year note yield is back down to 2.5%. From 3.5%, we've seen a dramatic drop and stabilization in the benchmark yield that we use here in the United States. So that's very much a positive. You've seen the VIX remain low. You've seen energy prices come down. The Fed got exactly the results it was looking for. Now, let's see what the next steps are. We also have to remind people, the inflation is not bad. When you have wage inflation or you have housing inflation, those are not bad things. Yeah, we've seen finally, corporations have been able to raise their prices. That's just a fact, a reality that we haven't seen in more than a dozen years. So That's where we're at. But corporations are doing extremely well. One last thing I want to talk about is its dollar demise. The dollar has turned over. That's what the Fed wanted. If you look at rates going out 24, 25, 26, you're seeing rates actually decline down to the 2.5% level. So it's getting the reaction we want. And if the dollar stops going up, guess who that helps? That helps Canada. But that helps a lot of these stocks that I look at. We got Alcoa, we got Freeport-McMoRan, we got U.S. Steel, we've got Cleveland-Cliffs. They've all had big bounces because it looks like the dollar has stopped going high.
A helpful chart to keep tracking for sure, the currency market connection to the equity world. Alan, thanks as always. Appreciate your time. Alan Nuckman joining us. And just a quick